Warren Buffett stated that intrinsic value is critical since it is the only sensible way to evaluate assets in enterprises. Intrinsic value is the discounted cash price that a business can extract throughout its remaining life in its simplest form. Calculating intrinsic value is not as straightforward as you may believe. Intrinsic value is a forecast that must be adjusted as interest rates and future cash flow projections change. Additionally, two individuals examining the same data will nearly always arrive at different intrinsic values. What does Buffett say about intrinsic value considering various calculations and approaches? Before continuing with the video, click that notification bell to ensure you don't miss any of our newly uploaded videos. Warren Buffett's most effective method for calculating the intrinsic value of a stock. Warren Buffett is the CEO of Berkshire Hathaway. He is an American philanthropist and businessman. He is one of the world's top investors with a net worth of over $100 billion. Buffett was born in Omaha, Nebraska. This video will walk you through how Warren Buffett determines a company's intrinsic value. More on discounted cash flows and his unique approach to every business. This will also help you find a company's intrinsic worth by using the discounted cash flow or DCF method. Buffett's value investing philosophy assumes that investors pay less than fair market value. As a result, value investors can use Warren Buffett's DCF valuation approach to evaluate a company's intrinsic value. Information is obtained, investors can assess whether or not to invest in a particular company as well as the price at which to invest. Number 1. Owner's earnings. According to Warren Buffett, owner's earnings are the profits a company makes for its owners. Regardless of how the money is deployed, the right management team will increase value to the business. Investors are also given the ability to sell at a premium in the future or generate income from a dividend payment. Buffett's calculating owner's earnings is represented by operating cash flow minus maintenance capital expenditure in a more simplified yet accurate manner. The formula for determining the owner's income is simple. Operating cash flow is a metric that shows how much money a business makes from its normal operations. Maintenance capital expenditures also refer to the money that a company spends on land, plants, buildings, technology, and equipment. Number 2. Growth rate. The growth rate is applied to the estimated earnings of the company's owner. This provides investors with an estimate of the amount of cash the business can create during the forecasted growth period. In 5 or 10 years. Warren Buffett does not employ a secret formula or model to determine the growth rate. Rather than that, he immerses himself in the company and the industry in which it operates. This includes revenue and cost drivers, current growth strategies, the management team, consumer and industry trends, and the robustness of the economic mode of the business. You can calculate the growth rate by dividing the difference of final and initial value by the initial value. Investors who lack this degree of expertise should proceed with caution and concentrate on reliable companies that are easy to understand. Select a conservative growth rate in your DCF calculation. Intrinsic value calculation will almost always be close to correct, even more so when a suitable margin of safety is applied. 3. Get familiar with discount rate. Applying the predicted growth rate to the most recent shareholders' earnings figure over the 5-year or 10-year time horizon, discount this cash flows to the present value to evaluate whether the stock price is currently overpriced, undervalued, or appropriately valued. This is due to the time value of money concept, which states that $1 acquired now is more valuable than one earned tomorrow. WACC is an acronym for Weighted Average Capital Cost. The weighted average cost of capital, which measures the cost of financing a business, has historically been used as the discount rate or hurdle rate in finance. On the other hand, the WACC incorporates numerous false assumptions and oversimplifications of reality, and the WACC formula is difficult to understand and is not suitable for beginners. Additionally, Warren Buffett does not use it, and as a result, as a retail individual investor, it is frequently definitely in your best interest not to compute and use the WACC as your discount rate. Number 4. Calculate your intrinsic value. For starters, two possible methods can be used. First, you may determine net worth by subtracting assets from liabilities. After getting the net worth, you can now divide it by the number of shares to get the intrinsic value per share. However, the value you can get from this formula ignores growth potential, so multiply with a suitable industry multiple. Secondly, calculate the average expected earnings per share for, say, next 5 years. Divide it by your cost of capital, and that is your share price. Number 5. Make an analysis based on a different scenario. When making predictions, it is common to do a sensitivity or scenario analysis to account for possible mistakes. This happens when many variables could affect the DCF value. This mainly refers to how Warren Buffett thinks about DCF valuation and how he thinks about the growth rate, discount rate, and owner's earnings. Scenarios help people think in new ways, so they are essential. Comes to business, you can have a worst case scenario, best case scenario, and a normal case scenario, with the only difference being the owner's income growth rate. After that, you can give each option a chance based on how well you know the company. For example, provide the normal case situation a 50% chance of happening, and the worst case and best case scenarios a 25% chance each. After that, you can look at how your intrinsic value calculations have changed. This way, you'll know what your rate of return would be if the company didn't do well over the next 5 or 10 years, fell in line with expectations, or did a lot better than expected. Number 6. Know your margin of safety. The underlying idea is that the lower your price for a firm, the less likely you are undervaluing it. If the company you're evaluating meets your growth projections to the penny, you'll be compensated at a specified discount rate. Previously stated, valuation is an imprecise science, and future cash flows are unpredictable. Therefore, if you've misjudged growth rates and thus the firm's fundamental value, using a margin of safety provides some protection, and as a result, your returns almost always exceed your discount rate. Determining a company's intrinsic value entails much educated speculation and should be undertaken with caution. Investors can further reduce projection error by investing in companies with a competitive advantage, stable financials, and a constant return on invested capital. Additionally, employing a margin of safety protects you from adverse risk, as no investor can completely trust their intrinsic value judgment in light of future unknown. If you are new to our YouTube channel, share this video with a friend if you found it helpful. Consider subscribing to our channel for videos about investing, business, stock market, managing money, building wealth, and other finance-related content.